Hey, this is Jeremy, the owner of Shine Insurance Agency and your host for the YouTube channel that you're on right now, Shine Insurance. Today we're going to talk about investment properties and we're going to dig in. So if you don't own any investment properties and you're just thinking about buying one, you have a couple or you have 200, if you want to understand insurance, we're going to break it down for you real simply, real easy right now. Property insurance basically has three types. The first is homeowner's insurance. Simply put, that means that you are going to be living in the house that you own. The second type is tenant-occupied houses, probably what most of your investment properties will be. This is when someone's living in the property that is not you. And the third is vacant properties, properties that don't have anyone living in them at all. The first type, homeowner's insurance, is not what we're going to talk about in this video. There's other videos on our channel. If you want to check out homeowner's insurance, you should go check those out. Let's talk first about the second type, which is tenant occupied. First of all, you really need to have a lease with your tenants. You need to have a lease set up. Probably have an attorney put that together for you so that your tenants have signed something and agreed to how they're going to take care of the space, what they're going to pay for, what they're not going to pay for, all those kinds of things. Why that's important when it comes to insurance is that insurance claims are based on those lease agreements. It's super important that you have those in place when a claim happens because the claims adjuster, the people that are working on the claim itself, is going to look at that lease agreement as a way of deciding who's responsible for whatever it is that happened, especially if it's a liability claim. So having a lease agreement is super important. Let's talk about the actual coverages. So there's basically two types of insurance coverage on your investment properties. One is going to be property coverage, as simply coverage for the structure itself. If a fire happens, if a tornado happens, if something happens to the structure of the home, we're going to take it back to the way it was before. We're going to rebuild it or fix the damage based on the insurance policy that you purchase. So the first kind of coverage you have is property. The second kind of coverage you have is liability. This is coverage for bad things that happen to other people because of your property. So if someone tripped on the front steps, or if there was something that happened on the property, someone was hurt and they either needed medical attention or they hired a personal injury attorney, and either way, your insurance policy has liability coverage there to help deal with that situation. In my opinion, you want to have at least $500,000 of liability coverage on your policy. If you have more properties, which means more exposure to bad things that happen, I would increase that to $1 million and maybe even have a $1, $2, or $3 million liability umbrella on top of that. Really depends on how much exposure you have, how many properties you have, and what your comfort level is with your liability coverage, how much coverage you want to have. You can never really go too high on liability coverage because if something bad happens, you want to make sure that you have enough liability coverage on your policy to deal with even the worst case scenario. So you have property coverage, coverage for the structure, and liability coverage, coverage for bad things that happen to other people because of your property. Those are the two types of coverage we'll talk about. Let's start with property. We want to insure our building for the amount of money it would actually cost to replace it. Now, this may have nothing to do with the amount of money you bought it for. In fact, if you got a great deal, it's probably going to be higher than the amount that you bought it for. In general, properties are insured from between $125 a square foot to even up to $200 a square foot for super, super nice properties. So that's the ballpark that you want to be in, but you definitely want to talk to your insurance agent and talk through the property coverage limit, the building coverage limits for your property, and make sure that they're properly insured. This is a great place to talk about the coinsurance clause. A coinsurance clause is really kind of insurance geeky, and I won't dig too deep into it. But basically, if you underinsure your property, if you don't insure it for the actual amount that it would need to be replaced, in a claim, even a small claim, they're going to penalize you in that claim situation and actually give you even less money than they should if you haven't properly insured the property. So A coinsurance clause is generally a percentage of what the house should be insured for. So if you see a 100% coinsurance clause, that's kind of concerning. That means that you're going to be penalized if you underinsured at all. If you underinsured at all, that coinsurance clause is going to come into place and penalize you. Most of the time when I put policies in place for investment properties, I want to see a coinsurance clause of 80%, which means there's some wiggle room there. We're going to insure for at least 80% of the replacement cost, and properly we should insure all the way to 100% of the replacement cost. But because that coinsurance clause is set at a lower level, we've got a little bit of leeway there so that we don't get penalized in a claim situation, even if it turns out we were a little bit underinsured. So if you have a coinsurance clause on your policy, 80% is what you want to see. And if you have 100%, you better make sure that you actually are insured to the replacement cost of the property, or you're going to end up in trouble in a claim situation. So we've got building coverage, the coverage that it's going to coverage for actually replacing your house. And then we want to be aware of that coinsurance clause as a part of making sure that our building is covered properly and our claims are paid in the best way possible. Okay, a couple more types of coverages we want to talk about. One is called business income coverage. You're making money off of these properties, right? You're getting a certain amount of rent from the renters each month, probably. If that house were to burn down and it was going to take a whole year to replace that house, then you wouldn't be getting income anymore. The renter doesn't have to pay rents if that property isn't there for them to live in anymore. And so you lose income because of that. So not only are you having to rebuild this space, but you're losing income that you would have had if the bad thing hadn't happened, if the fire or the tornado or whatever hadn't happened. And so I suggest that you have building income coverage on your policy, business income coverage on your policy, and you have that for the amount of money you would make off of that structure. So if you're getting rents of $10,000 per month from a given structure, then you want to make sure your business income coverage is set at $10,000 per month. Now, there's lots of little details on business income coverage. Not going to go too deep into it right now, but definitely make sure you have business income coverage on your policy. There's lots of other types of coverage on the policy. There's cyber liability, there's equipment breakdown, there's all different kinds of little things that I'm not going to dig too deep into because this video is just generally about investment properties. So you definitely want to talk with your insurance agent and ask, what do I have? What don't I have? And make those decisions. If your insurance agent included something that ultimately you don't want to have, that's okay. You talk it through with them. You decide to remove it. No big deal. So talk through the property coverage, talk through the liability coverage, make sure the coinsurance clause is at about 80%, if not lower. Make sure you have business income coverage on your policy, and you should be all set. Last thing I'll talk about before kind of going to the next step is you're going to have a deductible. My suggestion for properties, if you have multiple properties, is at least $2,500. You don't want to make a bunch of small claims. It's going to make your insurance premium go up anyway. So have at least a $2,500 deductible. And if you have lots of properties, you might even have a $5,000 or $10,000 deductible on your insurance policy, making sure you don't make those small claims and get yourself in trouble with your insurance premium going up because you had 2, 3, 4 claims in the last couple of years. That's definitely what you want to avoid. So having a slightly higher deductible, $2,500 at least, is a smart idea on investment properties. After you put the policy in place, oftentimes the insurance company is going to want to come out and take a look at it. And there's a few things that they're looking for and might suggest you make changes about, so I thought I'd just point it out. If you have any stairs in your house, either outside or inside, they're going to want to have a hand railing on those stairs. If you have a sidewalk that has cracks or different levels, they may want you to level it or figure something out about that. If you have older roofs, they may decide to either change the coverage on the roof to what's called ACV coverage, a lesser coverage, or they may even say, the roof's too old, there's probably going to be a claim soon, and we don't want to insure the property. So you would have to replace the roof or find another insurance company who's willing to insure a house with an older roof. So roofs, furnaces, handrails, the fact that there's fire extinguishers in the house or smoke alarms, if you have a sprinkler system in your apartment complex or something like that, That'll be a positive as well. Just all those kinds of things are parts of how the insurance company is going to take a look at the property after the policy's been put in place to make sure that it's up to the standards that that insurance company expects when they're insuring a home. So that's pretty much it. If you are looking to invest in properties, it's a great investment. They're a wonderful way to invest your money and make money on top of that over the course of time. Lots and lots of people invest in properties. I hope you learned a little bit about property insurance in this video. And please go ahead and make comments below. Ask me the things I didn't talk about, and I'm more than happy to describe those to you. So until the next time, have a wonderful day.